portfolio rebalancing. This is the last class that we will be learning about portfolio monitoring and rebalancing. And to conclude, we are going to learn about rebalancing strategies right there. Before we learn about the strategies themselves, we need to bring about distinction between rebalancing to target weights versus rebalancing to allowed range over there. So we have one side rebalancing. So you set a number of weights that you intend to target like that. So you're saying it's 40%, and here we are talking about now 35% like that, and an allowed range like that. So we're saying to target weights, and over here we're saying it is say 45% like that. So we're trying to target specifically 40%, and that's what we're saying is rebalancing to target weights right over here. So it's say 40% and 35% and 45% on the further extreme. Yeah. So we are saying that now on the other side, we should be able to have rebalancing to an allowed range. Rebalancing to an allowed range. There, that. And we can start by mentioning this or by highlighting, and I'll be able to emphasize this using a red pen. So the first point over here is that rebalancing to target weights seems to be costly, or it is costly. So we're saying that this is expensive because we are going to rebalance and we're going to have a lot of turnover rates. And turnover means actually buying and selling of securities at a higher cost, and that proves to be much costly as compared to rebalancing to an allowed range. This is less frequent over here. This is more frequent over here, and we're saying because of frequency. Expensive due to frequency. Less expensive due to less transactions taking place, less frequency in trading. There. So we're saying this is expensive due to frequency, or it's more frequently performed. This is less expensive due to less frequency in trading. The second point over here is that it allows for accurate alignment of the portfolio, allows for accurate alignment, allows for accurate alignment. And this one allows for room for tactical adjustments over here. Allows for accurate alignment, and over here is less alignment. So we're saying we're having it's not as accurate. Does not have or implement an accurate alignment. An accurate alignment over there. So what is this alignment we're talking about? We are saying that when you're rebalancing using target weights over here, it is accurate because you're saying that you are going to allocate the portfolio to a specific percentage allocation, either 20%, 30%. That is what you're saying that it allows for accurate alignment. This one does not allow for accurate alignment because you're saying it is rebalancing to an allowed range between 15% and maybe say 35%. So long as it's within that range over here, then you're saying that we're actually going to rebalance the portfolio to that range, or to be within that range over there. And we're saying for this one, for rebalancing using target weights, does not allow for room for tactical adjustments. Does not allow for tactical adjustment. Tactical adjustment, like that. Here we are saying it allows for tactical adjustment. Allows for tactical adjustment, like that. We are saying that does not allow for tactical adjustment. What do we mean by that? We are saying that the allocation or the rebalancing can actually take effect on a frequent basis over here, and here allows for tactical adjustments that can actually take is actually a much more, this one is actually less frequent, yes, in terms of the trading, but here it allows for tactical adjustments in quite a number of times. It's much more flexible like that. And this one does not allow for tactical adjustments on that side there. So we can move on and proceed to look at what we call rebalancing strategies. So rebalancing strategies. Rebalancing strategies are different from rebalancing disciplines because you're saying that rebalancing disciplines takes place or has got two variants. The first one is called calendar rebalancing. The second one is called percentage of portfolio rebalancing. As far as the strategies are concerned, we are looking at the techniques or the tactics that are used by portfolio managers so that they can be able to rebalance the portfolio adequately there. And the first one right over here is buy and hold. Buy and hold strategy. Under this strategy, you can say under this strategy, no rebalancing takes place. Once the allocations have been done, the allocations have been identified. Once the allocations have been identified, we can say the portfolio is not rebalanced for changes. The portfolio is not rebalanced under any circumstance. So we're saying if you have a 60-40 kind of allocation to equities and bonds, this 60-40 allocation remains, even if the external factors or the pastel factors actually impact on the portfolio negatively. What happens is that we just buy and hold and allow the portfolio to actually take shape based on this allocation right over here. So that's the first type of strategy that we need to know. The second type of strategy is the constant mix. Number 2, constant mix, right over there. So what happens under the constant mix? Here, periodic rebalancing is required. In this strategy, periodic rebalancing is required periodic rebalancing is required and results in little protection in downtrending in a downtrend and performs in downtrending market and performs poorly in up markets. Does not perform well in upward trending markets. So the target of stocks, and we are saying that the portfolio manager usually uses a formula like that to try and rebalance the portfolio. So we're saying target allocation in stocks is equals to M times portfolio value. M times portfolio value. M times portfolio value. And we're saying that this M represents a constant between target stocks. So M is a constant of target stocks and lies between 0 and 1, right there. So having looked at the constant mix like that, we can be able to see that in this strategy, periodic rebalancing is required. So we're saying the keyword there is periodic rebalancing. Periodic rebalancing is required and results in little protection in downtrending markets and performs poorly in up markets over there. So how about the constant proportion portfolio insurance, which is the third rebalancing strategy? So number 3 is constant proportion portfolio insurance. Constant proportion portfolio insurance. This is also called CPPI over there. So what we're saying is that it's slightly almost similar to the constant mix formula there, but we're saying that here the investors sets a floor value. The investor sets a floor value, and the floor value does not wish assets to fall. And you're saying that that floor value under which the investor does not wish the value to fall below. Does not wish the value, the floor to fall below over there. And we are saying that the target is given as the target allocation in stocks. It's just similar to that formula there. Target allocation in stocks is given as M times, open the brackets over there. We're talking about the portfolio value minus the floor value. P minus F, where P, portfolio value, F, floor value. Over there, like that. And once we have looked at those 3 strategies, specific focus should be given to the constant proportion portfolio insurance. And we are saying that the investor sets a floor value under which the investor does not wish the value to fall below. Well, this is the floor value right over here. That's what we are saying that the allocation should actually be geared towards there.